Hi, how are you? Today we are meeting in the double entry exercise section. We are going to do exercise number two, task number two. We are here, you can get a good idea how to pass the double entries. Okay, and here exercise number two. Uh, First adjustment is Amar, the owner, introduced 50,000 into the business by depositing into the bank of the business. Then you have to identify the accounts which are going to affect it. Okay, one is owner introduces, means owner's account or capital account. Okay, here we will say debits and this side is a credit. Okay, owner or Amal, we say Amal account. Okay, is going to affect it. Amal accounts or capital account, we can say capital or capital. So he introduced the money. Okay, he introduced the cash into the business. Where how he is introducing, he is not bringing the money, he is depositing to the bank. So bank account also getting affected. Bank. Okay, here you will have a dr and here you will have a cr. Okay, so what is the double entry for this? Hmm? Do you have any ideas? Already in the first exercise I have somehow explained to you how to pass the double entries. Here Amar's account, Amar is bringing the money into the business, right? Into the business, in the sense into the bank. He is depositing it to the bank. So bank account is bank balances always classified under assets account. If it is classified under the assets account, there is a increase in the assets. So the 50,000 will be debited. Anything increases into the bank assets will be debited. Anything decreases in the assets will be credited. Okay, as such. So Amal is the owner. He's giving the money. So he become a creditor or he's become a Amal is the liability for us for the business. From the view of the business, Amal is the creditor, or we are liable to him, we have to pay him. So liabilities are increasing. When the liabilities are increasing, it has to be debited, sorry, it has to be credited. Okay, so 50,000 you have credited. Okay, how do you put the narration? You will put the date. We have not mentioned the date because this is the beginning level. So here you will put bank account. Okay, bank. Okay, here you will say Amal, right? In Amal's account, that is the capital account, you can say capital account is credited to him 50,000 and we are debiting to the bank account of the business. Okay, this is business account. Okay, so Amal owner introduces 50,000 to the business by depositing into the bank account for the business. So the affected accounts are, one is Amal's account and another one is bank account. each and every transaction will have two effects. That means debit and credit. Here we are debiting to the bank and crediting to the Amar's account. Okay, so this is the first double entry for the first adjustment. For second adjustment says the business buy shop building for 5,000. The business per buy shop building for purchases. So right, what are the two accounts affected? There will be definitely for this transaction there will be a debit and there will be a credit. Okay, the shop building is an asset. So when you are purchasing the shop building, there is a increase in the assets. Okay, if there is an increase in the assets, it has to be debited. Okay, 5,000 debited. Okay, this is called building account. Here we will have dr and here you will have a cr. Okay, this is building account is debited, and where the credit corresponding credit account credit is goes to, because cash account we are paying out of the cash. If there is a decrease when we are paying out the cash means we are paying means cash going out of your entity, out of your business. If it is going out of the business means the cash is decreasing. If the cash is decreasing, in the sense assets are decreasing. If the assets are decreasing means the credit entry has to be passed. Okay, so this affect the cash account. Here is dr, here is the cr. What is the account affected? Cash account 5,000. Okay, what are the corresponding entries? Here you will say mention building. Okay, here you will say cash. Okay, this is the entry. So you have to go through the my previous chapter. I think not the this is chapter number 7. In the chapter number 6 you can see the idea I have given, how the debit and credit we have to pass for the assets, liabilities and equity, expenses and revenue. When there is an increase in the those elements, what are the entries has to be passed? If there is a decrease in those elements, what are the entries we have to pass? Like that I have given an idea there, so you can refer that and come and do this exercise. Then it will be helpful for you to understand easily. Okay, third adjustment is the business buy goods for trading for rupees 2,000 on credit from Mr. K. Okay, we are purchasing the goods. If we are purchasing the goods, in the sense goods are coming into the business, goods are coming into the business, in the sense goods are trading stocks. Trading stocks are asset of the company, current asset of the company. Current assets are under the assets. So if the goods are coming into the company, in the sense the asset is increasing, then we have to, when the assets are increasing, we have to pass the debit entry. Okay, then we have to say purchases. Here debit and here credit. Purchase, purchase account. Okay, purchase account, and we are debiting the purchase account with 2000. Where do we credit? Because other entries we are paying, we are purchasing on credit. Credit in the sense it is a liability. There is an increase in the liability. If there is an increase in the liability, the entry has to pass is credit. The double entry is credit. So what we will have to do is this side is dr and this side the cr. Okay, then we have to say creditors k. Okay, creditors account. So we are crediting to the creditors. It is amounted to 2000. What is the reference we are going to give? Here you have to say purchase. Here you have to say creditors. Okay, okay, case account. Okay, so here all these debits and credits are decided upon whether it is increases or decreases in the assets, liabilities, equity or capital, or revenue or expenses. Okay, so here I have given you the answer for adjustment number 3. Next one is adjustment number 4. Business purchase a van for rupees 5,000. Business purchase a van from for 5,000. We would say this is cash. Okay, purchased for cash. Okay, purchase cash. So the accounts which are going to affected here is van is the asset. Okay, so when you are purchasing the van means van is coming into the business, property is coming into the business. Property is an asset. Okay, van is an asset to the company. So there is an increase in the assets. If there is an increase in the assets, then debit entry. Okay, we had to pass 5,000 to the vehicles account, van account, that means vehicle account, and other thing affected is cash account. Okay, here we will say dr and here we will say cr, cash. Cash account. Cash account, because here we are purchasing van for 5,000, in the sense when property is coming inside and another property, when another asset, cash is going out. Cash is going out in the sense there is a decrease in the cash. There is a asset is decreasing. If the asset is decreasing, then credit entry has to be passed. Okay, what are the correspondent entries? Here you will say when. Here you will say cash. Okay, these are the double entries. There is a both a van and cash account, both are classified under the assets. One is under the asset and one is under the current assets. Okay, this is both assets. What happens, one is increasing, this asset is increasing. Okay, this asset is increasing, this asset is decreasing. Okay, carefully watch this active. Okay, this transaction happens, and when this transaction happens, it happens within the both double entry take place within the assets, not with the asset and liability. So within the assets, one side asset is increasing, on the other side asset is decreasing. When the asset is increasing, you are passing debit. When the asset is decreasing, you are passing credit. Okay, so next adjustment, the business make cash sales for 3000. Okay, the business make cash sales for cash sales for 3000. Okay, 3000 means what are the accounts going to affect it? One is cash account. Okay, here we will say debit, and here we will say, here we will say dr, and here we will say cr. Next account affected is sales. Okay, cash account and sales account. Hi, why the business make cash sales? Cash sales in substance, cash sales, cash is coming inside the company, then cash account is debited, because cash, where cash is determined as a asset, so cash account is debited with 3000. Other account, which what is the other account get affected? Sales account, because we are selling the goods, we are holding it for the resales. Okay, we are selling the goods which is held by us for the resale. So when the goods are going out, then that is decreasing the asset. Okay, decreasing the asset in one point of, one point of thing is that. And other thing is sales is regarded as a revenue. Okay, all the revenues are credited. Okay, all the revenues are credited, then automatically sales, you don't need to think otherwise, automatically the sales become a credit. You will say credit. Okay, this is, you here you will say the reference cash sales, here you will say sales, sales. This is for sales. Okay, this is sales. Cash is, cash account debited with the 3000, sales account credited with the 3000. Okay, so this is the explanation for cash sales, for cash sales for business. Cash account is debited because cash is increasing, and sales means revenue increasing means it has to be credited. Okay, and next we will come to the sixth adjustment, business sales remaining goods for 2000 on credit. Okay, then if we are selling it for the credit, the account affected is debtors account. Okay, it is debit side dr, and this is cr, and the account affected is debtors. Okay, here another account affected is business sells remaining goods for rupees 2000. Sales account. Another account which is affected is sales. Debtors are increased because we are selling on credit basis. Debtors are assets for the company. So if there is an increase in debtors means there is an increase in assets, then debit. Okay, and uh, cash sales is an revenue. Then all the revenues are credited. Okay, then you are crediting 2000. Here you will say debtors. Okay, debtor. Here you will say sales. Sales. Here business sells remaining goods for 2000 on credit. Means there's an that is the credit sales. So credit sales since debtors are increasing means assets increases, then it is debited. Sales are revenue, there's a increase in revenue, then it is credited. Sales are credited. And thereafter number 7 adjustment is business pays 1000 to Mr. B. Who is that Mr. B? Sorry, business K. Okay, this is so belongs to business Mr. K. Okay, Mr. K. Okay, because we have business purchased, we have purchased goods for trading 2000 on credit from K. Okay, so business pays rupees 1000 to Mr. K. When we are paying, he's a creditor. Okay, Mr. K is a creditor. So we are going to debit for the creditors. Okay, this is dr and this is cr, and we say creditor. Right, another account which is affected is cash account. So cr and this is debit. Okay, creditor and debtor. Business pays 1000 to Mr. K. Creditor, he's the creditor. Payment cash is going out means asset is decreasing. If the asset is decreasing in the sense, it has to be credited. Okay, then we are crediting 1000 with the cash account. The when we pay to the Mr. B creditor, the liability creditor is the liability is decreasing. If there is any decrease in the liabilities, it has to be debited. Okay, then we are debiting the business. So what is the difference going to give is cash here. Here we are going to give is as creditors. Okay. and business space 1000 to Mr. K means creditor. Okay, bracket creditor. Okay, if there is any decrease in the liability, it has to be debited. If there is any decrease in the cash, that also when there is a decrease in the liability, it has to be debited. If there is any decrease in the cash, it has to be credited. Okay. Eighth adjustment is business pays electricity bills for 5,000. What are the accounts affected? One is, here we will say DR, here we will say CR. One is electricity. This is an expense account. Another thing is cash. Here DR and CR, cash. Right? This electricity account is an electricity payment is an expenses. Right? Business pays electricity bill for rupees 5,000. Expenses are debited. Okay, here we are going to debit. Okay, expenses. For when from where we are paying? We are paying out of the cash. If we are paying out of the cash, in the sense there is a decrease in the assets. If there is a decrease in the assets, it has to be credited. Okay, then 500 we are crediting. What is the narration we are going to hear? We will say electricity. Here we are going to give cash. Always keep it in your mind that revenue is always credited. If there is an increase in revenue, always credited. If there is an increase in the expenses, always debited. Okay. So electricity is an expense, we are debiting. Cash is an asset, it is decreasing, so we are crediting. So that is the simple method to understand. Next, ninth one is adjustment is business receives half of the amount receivable on credit sale. Okay, credit sale. Because we in the sixth adjustment we say business sales remaining goods for 2000 on credit. So first of all, we have to identify what are the accounts going to affect. One is the cash account. Okay, cash. Other one is, what is the other account is affected? He is the debtor. Okay, business sells remaining goods for credit. He is a debtor. Okay, debtor's account is going to affect account. So business receives half of the account receivable on the credit sale, half of the account, because business going has to receive 2000 rupees, right? Business has to receive 2000 rupees. Out of 2000, 50%, half of it you are going to receive. What is that amount? Is 1000. Okay, cash is increasing, right? When you are receiving the cash is increasing means your asset is increasing, so it has to be, cash account has to be debited with 1000. And debtors are the, they also the current assets as coming under the assets. debtors are decreasing. When the debtors are decreasing, it has to be credited. Okay, debtors are has to be credited by 1000. Okay, debtors, cash account debit and debtors account credit. What is here? You are going to give the narration debtors. Here you are going to say cash, right? So cash account debited and debtors account credited. Business receives half of the amount receivable on creditor. Amount receivable always coming under the current assets. That is debtors. We are receiving means debtors account going to decrease. If it is going to decrease, we have to credit the amount. Okay. We are receiving the cash in the sense cash going to increase it. So when the cash is going to increase, the assets are going to increase. If the assets are going to increase, we have to pass debit entry. Okay, understood? Now, 10th and last adjustment is the owner takes 1000 rupees cash. The owner takes 1000 cash from business. Means we can say one is, we can say drawings. Okay, this is debit and this is credit. Okay, one account is drawings, or we can say capital account or drawings account, we can charge it, but here I prefer to charge it to drawings account. At the beginning itself I want to guide you correctly. Okay, the owner takes 1000 cash from business, means that is drawings. You are borrowing money, you are taking out the money from the business, right? You are separate, business is separate. You are a different person from the business, right? So it has to be segregated, the transactions has to be segregated and it has to be treated accordingly. Drawings account and another, what is the other account affected? Tell me, will you? Other one is cash account. Yes, this is CR. Okay, drawing accounts means drawings in the sense he has to give, the owner has to give money for us because he's taking out, then he had to repay for us, then that is he's coming and drawing another data. Data means there's an increase in the assets. If there's an increase in assets, we have to pass a debit entry. Okay, we have to put drawings 1000 debited. Okay, and cash is going out because he's taking the cash and walking out of the business, then cash is going out. Then if the cash is going out, the assets are decreasing. Assets are decreasing. Okay, if the assets are decreasing, we have to pass a credit entry. Okay, drawings 1000, 1000. Here you will say cash, here you will say drawings. Okay, that's all. So now uh, earlier chapter, in previous chapter, I have recorded all the transaction exercise. I have given one exercise in which I have opened a single accounts, right, for every transaction. So I thought it will be difficult for you all as you are a beginners. I thought you may feel difficult to understand it. That's what I have opened TA cards for each adjustment separately. Then you can understand properly, uh, and easily understand, and you can go through it again and again. If you don't understand, you can go through it again and again. For each and every adjustment, you can pass the TA counts and go through it. And I hope under you all would have understood this transaction, okay, in this exercise. If you have, if you want more uh, exercises, you can refer my next chapter class, okay. In yeah, in the previous chapter I have shown in all the adjustments shown in the separate TA counters, in common TA counters. But in this exercise number 2, I am showing the TA count separately for each and every adjustment for you all to understand easily, okay, for easy understanding purposes. Because I thought that exercise number 1 presentation may confuse you. So that's what I prepared the exercise number 2 to give more idea for you all to understand. Okay, just go through these all transactions and check whether you understood or not by passing entries yourself, your own self. So you can check with the answers here, okay. Okay, we can meet you in next exercise. Okay, thank you very much for watching this video.